Welcome back. Indian Hotels is celebrating what they call their Capital Markets Day, and they held an analysts' conversation yesterday. Well, to be sure, capital markets are extremely pleased with this company. I was just looking at the year-on-year increase in the stock. It's a 65% jump that the stock has given in the past year. And if you notice, the Nifty didn't do much in the past 1 year. It's just been hovering around, a narrow range. At the analyst meet, the company actually bettered some of the forecasts than some of the guidance that they'd given after their results. So to understand more, we have with us Puneet Chhatwal, Managing Director and CEO of Indian Hotels. Mr. Chhatwal, thank you very much indeed for joining us. You know, your Q4 numbers, I think end April, were themselves really mind-boggling. EBITDA margins doubled 18 to 33% from year-ago levels. Is 33 really sustainable?
Absolutely. Good morning, Lata. And we've been giving that guidance under the strategy which we call Avan 2025. Avan stands for execution or call to action in Sanskrit. And we have consistently raised our margins since the last 5-7 years. We went from 16-17% to 24% pre-COVID. Then there was a dip because of the lockdown. And since then, we guided 33% for the business cycle. Many analysts expected us yesterday to raise the guidance, but we said if we get more, we get more. But our main focus of the management would be on the diversification and optimization of the top line. And 33% margin, we feel, is strong and good enough as long as the top line is optimized.
Fair point. I mean, an 86% growth in top line. So that itself is very telling. But you did revise one number higher. You said the management fees you're expecting is going to be 550 crore. Earlier, you had told us 400 crore. So you are expecting revenue to better your own guidance, looks like.
Absolutely. It's mainly related to our growth, and our growth in our pipeline has gone from 10-15 hotels to almost 75 hotels, despite having opened 50 in the last few years. So our not like-for-like growth will have a huge impact on the management fee earnings because most of our pipeline is asset light. And we have achieved almost 400. The correct number was 399, which was almost double than 4-5 years ago. And we expect this number to easily reach 550 because we are expecting to open, as of this financial year, a minimum of 20 hotels per year. And last year we ended at 16. We had hoped for 17 or 18. But some opening permissions did not come through. So as of this year, the number should be north of 20 hotels in a year. And
you're not ruling out M&As. So that'll be extra.
Definitely not if good opportunities come up with the platform that we have together with GIC, but also with our own free cash flows that we have now. I think we are very well positioned to take advantage of any such opportunity that may arise.
Okay. Mr. Chhatwal, a skeptic's question, which I think some investors may have. You did roaringly well when there was revenge travel after COVID. Plus, a lot of your smaller competitors couldn't really manage to stay afloat with 2 or 3 years of no revenues and huge fixed costs. So is this maintainable? I mean, look at your ARR or look at your occupancy, 71%. Can it get better than that?
Well, the occupancy, given the Indian landscape, anything between 70 to 75 is a very good number because of the seasonality impact, especially in Q1 and Q2. Because of school holidays, monsoons, extreme heat in certain destinations. However, the rates still can go up. I was just last week in Europe, and, we are... as they say in other European languages, we are complaining at a very low level. Hotels comparable to, let's say, our Taj brand are boasting of average rates which are 5-6 times higher than what we are getting. So even if we stayed at that level, I think it's a healthy level, and the price as well as occupancy is a consequence of the balance in demand and supply. As demand is back, aided by some more latent demand that has happened because of COVID, and the supply is constrained, I think the macro factors make the sector very resilient, and within that, strong brands like ours are even more resilient to changes in the price offerings of other competitors.
So, you know, your ARR, your average room revenue has gone up from 10,700 odd crore in Q3 to 11,560, sorry, not crore, 11,560 in Q4. You think there is headroom at the same pace?
We do believe with what we have seen in April and what we have seen in the first 2 weeks of May, as well as the business on the books for the rest of May, we are still trending higher than last year. I always say, with the best yet to come in terms of the peaking out of events of G20, in terms of the World Cup cricket. And as of October, we are expecting to go back to the foreign tourist arrivals of a pre-COVID level, which last year ended between 60 and 68%. So there is a lot of headroom out there. Coupled with that, of course, there is a bounce back that is also happening for us in the markets in the US, in London, in Cape Town, which are still lower than what one would say adjusted for inflation for 4 or 5 years ago. Okay. So I think we expect some positive tailwind from US, Cape Town, as well as our London property.
So very briefly, will the international portfolio become profitable? Are they already profitable?
The international portfolio has always been profitable. It's just the accounting. The way it happens is the management fee income coming from international goes into standalone. Okay. That is a requirement under the accounting laws, the way it works. But if we were to add back the management fees of, let's say, our 3 hotels in Dubai or the other properties, including the hotel in London, the international portfolio is profitable.
Okay. Now, finally, on capex, you have about 2,300 rooms in the pipeline, you told analysts, for FY24. Now, what sort of capex does that mean? And will it mean increase in debt?
Firstly, we have no debt, so we are net debt positive. We have one debenture payment left in June, but the QIP funds which we have are already allocated for it. So we are sitting on almost 1,000 crore net positive. The second is any hotel opening in which we have our own capex. Yes, there is one, but we are paying for those costs from our internal accruals. That's our flagship, the Ginger in Santa Cruz. The rest is all asset light, and in all we have almost 10,000 rooms in our pipeline, with the exception of 2, a combo Vivanta and a Ginger in Ekta Nagar, 1 Ginger in Santa Cruz, and 2 in Lakshadweep, which are planned but will not open that soon. The Lakshadweep Islands is a very big project. We don't have really any capex requirement for new properties. Okay. However, some of them will still be counted as asset heavy because we have signed some operating leases for Ginger, which we think is the right business model for Ginger properties. And the rest is on asset light, which means management fee income. And that's why the guidance going from 400 crores to 550 crores by 2025 on management fee income.
Okay. Pleasure speaking with you, Mr. Puneet Chhatwal. Pleasure to hear such, positive guidance. I guess Taj is the jewel in the crown for the Tatas. Thank you very much indeed for joining us.
Thank you, Lata. Thank you for having me.